stop keeping money in current and savings account, buy a T-bill. A government T-bill, easy click buy, gives you still 5.5, 575. I'm not a big fan of fixed deposits, but you can still put 3 to 6 month fixed deposits. But just make your money work for short-term goals. You need fixed income always in your portfolio. I think people who invested in 10-year government bonds last year have actually made double-digit returns in government bonds.
Finally, in general, there is one concept in bond investing that everyone should take note of, which is something called the yield curve. Hello and welcome to episode 2 of Bondstreet, brought to you by Mint and powered by IndiaBonds. We have today Vishal Goenka, CEO of IndiaBonds, to discuss a very interesting idea in bond investing. How do you map your goals to specific bonds, to specific categories of bonds? Welcome, Vishal.
Thank you, Neil. Pleasure to be here again.
Vishal, so let's start with the basics. People have financial goals at different levels of time and for different needs. So at the very short term, you might have somebody wants to go on a holiday. People have school fees to pay. People have homes to buy. And you can sort of adapt your bond strategy to these goals, right?
So I think, when we talk about financial goals and fixed income, I will highlight two main things. One is you need fixed income always in your portfolio. So whatever the size of your portfolio be, typical allocation is about 20% in fixed income. If you're not that sure about equity markets, you can go as high as 30 to 35%. Whereas financial goals are concerned, I think there are two horizons really. When it's very short term, I literally urge people that stop keeping money in current and savings account. Even if you have money for 3 to 6 months, 9 months, buy a treasury bill, buy a T-bill. A government T-bill, easy click buy, gives you still 5.5, 575. I'm not a big fan of fixed deposits, but you can still put 3 to 6 month fixed deposits. But just make your money work for short-term goals that I have money, I need in 6 to 9 months. However, I think life goal planning via fixed income is amazing, right? So the examples that I see from our clients is people say, I want to buy a house in 5 years, or I want to buy a car in 3 years. I want to save my children's education in 5 years. So what we suggest is whenever you have money to save, you do a bullet maturity. For example, your child needs to go to college, you need to fund it in 2030. So today you buy a 5-year bond. When you have more money next year, buy a 4-year bond and target all maturities to come at the same time. So you can really use that as a saving tool for financial goals.
Right. So let's come to that in a bit, Vishal. But first, if we could start with the very short term. So you said something called T-bill or treasury bill. So
Yes.
This is a government bond.
That is a government issued instrument.
So the risk is almost negligible. And it's short term. So again, interest rate is also, the risk is negligible.
Yes.
And the prevailing interest rate right now is 5.5% to 5.75%.
For treasury bills.
For
T-bills.
treasury
Right.
bills. And what is the process of buying a treasury bill?
So basically what you got to understand that short-term rates, the anchor and the foundation is the overnight repo rate, which is the level of interest rates set by a central bank in any country. It's 5.5 right now. The process is very simple. There are multiple platforms that you can go to. There's RBI Retail Direct, which the government started, where you can just click and buy. You can come on online bond platforms like ours or others and click and buy a T-bill. The only difference is when you buy in RBI Retail Direct, it's something called an SGL account. So it's like a note within RBI that you own that. And when you buy it on online bond platform, it comes in demat form, so you can see that statement, right?
Along with all your other stocks.
Along with everything else that you have in demat.
Yeah. Right. And you have to do your KYC first, I assume.
Absolutely. Any financial investment in this country on any platform, you would need to do KYC first. Yes.
And you can use UPI to transfer the money, right?
Absolutely. UPI is possible on online bond platforms. I'm not very sure about RBI Retail, but it should be possible.
And when the T-bill matures, the money is credited automatically to your account, or you have to do some action?
No, money is any bond investment you do, whether government, T-bill or corporate bond. Just remember, every interest payment comes directly to your bank account by the issuer. And on maturity, all the money comes to your bank account, which is linked to your KYC. When you did your KYC, you linked your bank account. It comes back into that. Nothing to do at all.
Right.
It's automatic.
Right. And just for clarity, the taxation on the T-bill that you invest in is at slab rate, just like you face in an FD. But the advantage here is you could get a slightly higher rate than a corresponding FD rate.
Yes, you will get slightly higher rate, and T-bills are absolutely liquid. You can sell T-bills at any point. There's a huge volume that happens in the government part of the curve, so you can exit at any point of time and get your money T+1.
All right. Now let's turn to, let's say that you have a goal coming up in a 1 to 3 year period. You could have your kids' education or some other thing. What is the best way to finance that?
I think work hard, save money to send your kids to expensive education. But I think importantly, if you have a targeted horizon, then buying short-term bonds really serve that, right? Because if you were to choose a bunch of corporate high-yield bonds, and again, we can talk about how your portfolio mix should be there, you could make 9 to 11% returns, which is definitely higher than fixed deposits. They do come with a risk, and we'll cover that later today. But just target it. If your kid needs to go in July or August, or let's say whichever the term is, you just buy bonds that mature before that. So you do not want to risk that capital in other volatile asset classes. You should not leave it in bank at 6-7% fixed deposits. It's very easy. Do targeted maturity, anything that matures around 1 or 2 months before that, and invest in those bonds.
And ideally, it should be AAA rated.
It is upon risk appetite. Credit ratings come in 10 different shades, from AAA, AA plus, right down to BBB minus. I would highly discourage individuals to do BBB minus. It's the riskiest part of the curve. A AAA, it's upon your risk appetite. A AAA yields you 7 to 7.5%. If you go to a AA, it'll come to 8%. You start going to single A to BBB plus, you can make 10 to 12%. So, all the information is available there. It's on these platforms. You should read the rating reports and IM. Depending on your risk appetite, right? You should take that call.
Okay, so let's just zone in on the first two categories, which is AAA and AA.
Yes.
What are the default rates in these two categories?
I think in India, it's practically zero in the last 5 years. Yes, we did have some accidents in 2019 and 20. We had global accidents in 2008. In the US, a lot of AAA CLOs defaulted. But we were in a very, very different country at that point of time, from an economic point of view, from a regulatory guardrails point of view, right? So a lot has happened, a lot of positive regulation to protect the individual investor has happened since then. But in India, it's at 0%.
Right. So Vishal, in this medium-term category, unlike a T-bill, you do have regular interest payments or coupon payments.
Absolutely.
And that gives you some cash even as you're waiting for that goal to emerge. Can you tell us about the taxation of these bonds?
Yes, absolutely. So every corporate bond that you buy, you can choose from. I see a lot of people choosing monthly income or monthly coupon bonds to match their monthly expenses. They come in monthly interest payment, semi-annual, quarterly, annual. As far as taxation is concerned, all listed bonds, interest rate has a 10% TDS, and it's all the cumulative interest is at your slab rate. So it is at par with that. However, it is possible to make capital gains on bonds. And if you hold it, if your capital gains is over 12 months, it's 12.5% long-term capital gains on the gain that you make.
Absolutely. In fact, that's a nice segue into the third category that we are thinking of, which is bonds which exceed 5 years in duration to map to your goals which exceed 5 years. And typically these would be again government bonds or GSECs, right?
So, in my opinion, if you want to go then more than 5 years, the Indian corporate bond market is developed for a longer maturity, but only in the AAA and AA plus segment, right? So there are a lot of bank infrastructure bonds. There are a lot of large public sector bonds that you can invest for 10 years. Our government bond market is fairly very, very well developed. You have 50-year bonds, 2074 maturity as well. A lot of people, when they are coming closer to retirement, or I said they want, not to actively invest in bonds, and they say, okay, I'm going to buy a 10 to 15-year bond. I'm going to get a regular income, and that is good enough for me. And at around 60, retirement people definitely do that, right? So yes, if you were to do more than 5 years, you should just do AAA and AA plus. Government bonds offer an amazing opportunity right now, currently as we speak. So people can buy 10 to 15-year government bonds I think there's a potential for good capital gains as well as apart from the interest rate. They're around 6.6 to 6.9% currently. But that's a great way to do long-term investment in government bonds.
Sure. So let me just elaborate on the capital gains part of this argument. Basically, longer tenure bonds are more sensitive to interest rates, and if interest rates are cut, the value of the bond rises, and therefore you get capital gains. So if you sell the bond before maturity, then that rise in the bond's price is taxed at the long-term capital
That is right. That is correct.
gains rate, which is 12.5%, and it can be much lower than the slab rate that normally
Yes.
applies.
I think people who invested in 10-year government bonds last year, 10-year yields were on 7.1. We saw yields rally up to like 6.2 or 6.4, which is 4.5, which is currently right now, have actually made double-digit returns in government bonds because you earned the 7% coupon and your bonds have appreciated by 4 to 5% already. So in a risk-free, government bonds are called risk-free globally, and as in India, you could actually make double-digit returns.
Yes. But in this bucket, not just central government bonds, but there are also SDLs, so state development loans, which are yielding higher. So you could, what kind of yields can you get there?
So SDLs, very good point. State development loans, just for clarity, are basically guaranteed by the central government. So they are central government securities. SDLs trade typically from 40 to 75 basis points higher than the equivalent government curve, right? So hypothetically, if your 10-year is around annualized 6.5, 6.55, you could buy a state development loan, at 7.25 as well. So it's the same risk essentially. There is slight differentiation on the health of different states in the country. Not every state is the same, but that's a good way to earn a little more extra. But the underlying risk is almost the same. Yes.
And you would also put PSU bonds into this bucket, or even AAA corporate bonds, which have a high maturity, and that's also an option here.
No, absolutely. I mean, large public sector bonds, which have been, traditionally big issuers in the country, the REC, PFC and things like that. Yes, absolutely. I would put them in this category. The ratings are AAA, and they are very good credit to go after. Absolutely.
The final, I think, type of bond that also sits in this category, a little bit debatable, is what is called a perpetual bond that is issued by banks. They have a very, very long maturity, but they're liquid, so you can sell it. They have some liquidity, right? How would you judge that?
Perpetual bonds are a beast, actually. Okay, and I'll be perfectly honest with that. There is no final maturity, and there's a call option that every 5 years or so, the issuer can call back the money. Banks issue this because they get risk weighting credit, in terms of the leverage on their balance sheet. I think perpetual bonds should be only bought by sophisticated investors. There are public sector or large banks which have issued perpetual bonds. Globally, perpetual bonds or AT1, additional tier 1 as we call it, is there. But there is history globally and in India where AT1 bonds have gone to zero. So perpetual bonds are good, but I think they are for sophisticated investors. I think the minimum denomination is 1 crore actually, so it's not really relevant for retail. Because you're basically short, you're short an interest rate option. What do I mean by that? That if the coupon is at, let's say, 7% and yields go to 8, instead of owning a 5-year bond, you own a 50-year bond. So there is things called convexity or in bond stuff. And secondly is if the credit quality of the issuer goes down, that's the time you get hit because you have a loss absorption, right? So the AT1 bonds or tier 1 bonds have a loss absorption feature, not absolutely for retail, but yes, there's a flourishing large institutional market for the same.
All right. So if you see these AT1s listed on various platforms, do take a note of these risks.
Yes.
Finally, Vishal, let's talk about the studies that you mentioned where you can have different maturities of bonds. So to reduce your both interest and credit rate risk, right?
Yes. So the strategy is very simple. It's called laddering. If you are not a champion and you don't want to be a champion where the interest rates go up or down, and you should have fixed income in your portfolio at all points of time, you spread out the maturities. So let's say you have 5 lakh rupees to invest. So you buy 1 lakh bond maturing in 1 year, 1 in 2, 1 in 3, and 4 and 5. Now, what happens is then you're kind of hedged, right, with interest rate risk. If they change next year, you use that maturity and buy another 5-year bond. It's a very good rates agnostic or neutral strategy where you can have fixed income in your portfolio for a long period of time and do a laddering strategy. I think that's really advisable for portfolios.
And finally, in general, there is one concept in bond investing that everyone should take note of, which is something called the yield curve. The idea is quite simple. You get rewarded for being patient. If you buy bonds of longer maturity, the rates tend to be higher, but that rate of reward changes, right? It's a curve. And Vishal, how does that curve look like for India?
Good question. So yeah, there are two factors, as you said. If it's like if I loan you some money, if I loan you for 1 year, I'm kind of certain, or 1 week, it's going to come back. But if I loan you for 5 years, the time value has a certain uncertainty about it, right? So I should be compensated at a higher rate for it. In India, traditionally, we have something called a upward sloping yield curve. What do I mean by that? So your overnight repo rate is at 5.5. Your 3-month treasury or 6-month treasury bills go to 575. Your 5-year rate is 6. Your 10-year rate is at 6.5. Your 30-year rate is close to like 680, 690. We call it an upward sloping yield curve, which is very, very simple, which is, for if you lend for a longer time, you should be compensated. And this is typically the yield curve, which is very beneficial to the banking sector. It's a classic upward sloping yield curve, which is, you borrow at the short end in the banking system and you lend at the longer end and make that name. However, it's not always that the yield curve is upward sloping. Currently, the yield curve in the US, which is the biggest bond market, is inverted. So yield curve or long end interest rates are actually future expectation of interest rates. The economy largely has control over the short end, which is where will my rates today in 3 to 6 months. So currently in the US, the rates are 4.25 to 4.5, but the 2-year interest rate is at 375. The 10-year interest rate is at 4%. So what I call an inverse yield curve, where people expect the Fed to cut as soon as you are in the middle of September. The Fed meeting is next week. People expect that, and people expect that in the next year and a half, Fed will be cutting another 50 to 75 basis points. In India, currently we have an anomaly where we also expect, my personal opinion, that RBI is going to cut rates. However, the yield curve is very, very steep, which currently does not make sense to me, and I think people should invest in 10 to 15-year government bond curve. But very simple, yield curve is longer the tenor, you get compensated or should get compensated for investing.
Fantastic. So we've taken you through some of these goals and how you can map bonds to them. And as Vishal said, there are some interesting concepts or strategies like laddering or like the yield curve that you can study a bit and use to your advantage. Vishal, one really important aspect of bond investing is the risks of it, both government and corporate.
Yes.
Could you point out the risks that people face?
Absolutely. So firstly, no financial investment is without risks. There is no free money as such. But when you invest in government bonds, they're technically called risk-free, which means, the government of your country will give you your money back. There's nothing safer than that. So you do not have what we call credit risk because the person you've lent money to is risk-free. The biggest risk that you have there is what I call market or interest rate risk, right? When interest rates fall, bond prices go up, and the inverse, when interest rates rise, bond prices go down. I think currently we are in a reducing interest rate cycle. These cycles run for a few years. RBI has already cut by 100 basis points, and my personal opinion is there's more rate cuts to come. So it's always good to get into a good rate cycle when you invest in government bonds. Corporate bonds are very, very different because there are more than 1,000 issuers in the country. You have to study who's issuing it, right? So all this information is available. People should study, do a credit rating report analysis. They should understand the sector, look at the management. Credit rating is a good way to start because it gives you whether a credit is AA, single A, and match your risk appetite to that. but the same risk, market risk, credit risk as to if the company can do good or bad. And the third risk is liquidity risk, which is very important in corporate bonds, because similar to equities, where small cap has different liquidity than a large cap, if you buy a corporate bond, which is triple B plus, A minus, A rated, liquidity is little less in that. And if you buy a triple A, double A plus, they're very, very liquid. You can trade at any point of time.
Could you give us some early warning signs of credit risk? And since we now sort of live in the age of AI, are there good AI models that predict this?
Very, very good question. So, credit risk or credit lending has been largely an art plus science. So, I don't think AI models can do that. I think what AI models help you is to analyze, the 100-page information memorandums or issuance document. You can quickly analyze that and ask some very key questions. We do the same. We feed IMs to AI models to say, hey, what are the basic covenants or risks around that? The early, read the news. The early signs are typically equity of a listed entity of a corporate bond starts behaving negatively to start with. So if a company has a big steep downfall or downwards move in equity, that's a flag you should take. Secondly, is rating downgrades or rating outlook is very important. So a company could be single A rated, but if it's a negative outlook, which means the rating agencies are thinking that the next move will be downgrade or deterioration in credit. So people look at A minus, A plus, but they miss out the outlook.
They miss the plus and minus.
Yes. So the stable outlook, a positive or a negative outlook. So typically negative outlook, you should do more search on that. And if there is a rating downgrade, and if you do not have that appetite, you should try and exit that position. So I know it's happened, but you don't go from AAA to default. It's happened in the past. You will see an A go to A minus or A to triple B plus, and you will see the deterioration. But that's when the liquidity problem comes, because when ratings downgrade happen, the liquidity in that particular credit for some time goes away.
Thank you so much for watching, Vishal. Pleasure to have you as always.
Thank you, Reel. Always good to be here, and thank you for doing this series.
Thank you.